This is the expanded corporate accounting equation that we saw in your last section. Now let's focus on retained earnings. We said retained earnings were the amounts of profits that were earned and kept by the business. Let's take a look at the components of retained earnings. Retained earnings have three components: revenues, expenses, and dividends. Revenues are defined as inflows of resources earned by delivering goods and services to customers. I don't focus a lot on exact word definitions, but I do expect you to know how to explain an item and what a revenue would be. Let's say you go into Walmart and purchase 10 items. Whenever you purchase 10 items and that cashier scans in those 10 items, for Walmart, whatever the price you pay for those goods and services would be considered revenue. So if you bought a box of cereal and the box of cereal is $3.50, Walmart would have earned $3.50 of revenue. Revenue is whatever you earn by delivering goods and services to customers. In this course, whenever we talk about accounting terminology and about doing calculations, we are always looking at it from the terms of the company. We are accountants working for the company. So the revenue is Walmart's revenue. Expenses also are a component of retained earnings. Expenses are defined as resource outflows from the cost of doing business. Examples of expenses would be things like rent, salaries. Let's say you take Walmart again: rent, salaries, utilities. All those recurring items would be considered expenses for Walmart. The third element of retained earnings is dividends. Dividends are defined as distributions of assets to stockholders. You need to remember that this is not an expense. Dividends are something completely different. Some companies, when they're successful, they start giving back some cash to investors as a return on their investment. So let's say that you go and buy 100 shares of Walmart. Every year, Walmart will pay you about $1 or $2 per share you own as a return on your investments. That cash Walmart will pay their shareholders every year is called a dividend, and dividends are a component of retained earnings. How do revenues, expenses, and dividends affect retained earnings? Revenues increase retained earnings, expenses decrease retained earnings, and dividends decrease retained earnings. An easy way to remember is revenues is cash or other resources you receive by selling goods and services. Selling is good, so revenues increase your retained earnings. Whenever you have to pay a bill such as rent or utilities, those decrease what you have earned. Same thing with dividends. If we have to pay something back to our shareholders as a return on their investment, that will decrease the amount of profits we have in our retained earnings. So you do need to know the relationship. Revenues increase retained earnings, expenses decrease retained earnings, and dividends decrease retained earnings. We have another definition here. Net income is what we call the difference between revenues and expenses. So revenues minus expenses is equal to net income. If your revenues are less than your expenses, so if your expenses exceed your revenues, we will call it a net loss. So revenues minus expenses is net income. If your expenses are more than your revenues, we call that a net loss.